Hi guys, it's Carl Hinder, Salon Help, and it's Monday, it's midday, and this is our weekly video that comes out at midday every Monday on business issues that you have asked me to do. If you want a video on a subject that is important to you, just email me using the link and I'll get that done for you over the next week or two. This week, Tony has asked me about selling a property. Selling a business that may or may not include the property to existing people in your business. Now, I don't want to get too tied into this. If you want to know how to sell a business, you can easily do that by just going onto Google. That'll give you the most updated way of selling it, because you can include all sorts of valuations, including things like cash flow and taking away things like liabilities, but I don't want to get complicated. What I want to say is, if you're trying to sell a business on a traditional basis, not including the property, then what you're looking at is getting 3 years of accounts together, finding out the profitability, usually multiplying that by 3, that gives you your base price. You add on any assets like your chairs and equipment and mirrors and all that sort of stuff, that gives you your secondary price. And then you add in a customer goodwill, which is, the amount of custom that you have come into your salon at the moment, but it may also include things like the length of service of your staff or the quality of your team, and some other stuff like trademarks and signage and that sort of stuff. Now, the latter part is a problem, because you might want to try and add a value to it, but your customers are not very loyal these days, so they're not likely to stay, or they don't have to stay for sure, and the same with your staff. So if I was buying a business, I wouldn't take that into account personally. I wouldn't want to pay anything for it. It's not as if you're buying the accounts, or the book of a production company, of someone who's producing wings for airplanes or something. You're not buying the book. You're actually buying something that could disappear in one day. Okay? So let's not get too tied up on the traditional methods. Phone your estate agents, look on Google, it'll give you the current update. And I do know, because I've been involved with a lot of these over the last few years with clients, they're not usually very successful trying to get a sale on that basis. So what can you do? Right, if you've got staff or a member of staff in your team that is a good candidate to take over your business, you need to look at other methods. Sure, look at that method, which is valuing the profit, the goodwill and the assets, and you add a lump sum and then you sell it to them at that price. And if you're selling the business, you add that on, and if you're not, then you sell them the business and then you just rent the property to them at the market rate. The third option is this, and I think this is becoming a lot more popular, and it's something that I've been personally involved with. I would look at getting getting the business valued using 3 years accounts. It's important that they are verified, and you work out a value of the average of the last 3 years' profits and multiply by 3. So that gives the business a value. You then add the assets, the chairs, the mirrors, the staff room furniture, the reception desk, the laptop, the desktop, whatever it is that's in that salon, the TVs, everything. That gives you a value. And then you can look at how much value maybe the telephone number that you're handing over as, maybe the amount of customers that you have, and maybe the rest of the team, the signage, any trademarks, that sort of stuff. Now, you're going to have to just agree a nominal figure for that. So now you have an overall value that you add it all together and say, look, this is how much it would be if I was selling it. However, when you get to that stage, very often the staff come back and they say that they can no longer afford that amount of money, which is fair enough. This is what I would look at doing. I would look at looking at the standard rental rate for that property. Let's say, for example, it's £100. And then I would add up everything else that we've talked about. And let's say that came to £35,000 or £36,000, something like that. I certainly would be asking for a deposit if possible, maybe 10% of the £36,000. Or if it's £50,000, still 10%. So you get maybe £5,000 or £10,000, which shows that this person is invested in continuing this business. I would then look at leasing them the property for 7 years. In fact, 7 years minus 1 day. And that's really important because 7 years minus 1 day means they have no automatic right to renewal. So if they do make a bit of a mess of it, or you do want to get this property back, not the business, the property, access to it, then you can definitely do so after 7 years minus 1 day. Okay, it's just a little tip there for you. And then what I would look at with this 30-odd thousand pound minus the deposit is I would look at spreading that over the 7 years and adding that spread to the weekly rent. So let's say it was £35,000, that'd be about £100 a week. And then look at the rent, which might be also £100 a week. So, okay, you might want to take that deposit off, but just work on £100 a week for costs, £100 a week for the rent. So now they have a rental charge to you of £200 a week. I kind of hope that makes sense. So £100 will be paying for the rent. The other £100 is basically paying you slowly for the value of the business. You have a deposit to show they're serious, and you have a 7-year lease so that they are tied in. I wouldn't have a 3 or a 5-year get out clause. It's up to you, depends on your relationship. But if you've had a business for maybe 25, 35, 40, 50 years, you wouldn't want to jeopardize it over the next 3 years and have it ruined, because then it's actually worth nothing to you at all. Okay. Now, of course, the weekly rent, depending on your area, might be £500 a week, and the value of all the stuff spread over 7 years might also be £500 a week, in which case the rent that they are paying would be £1,000 a week. Okay. Now, I hope that's quite a simple way of explaining it. The lease is going to be important as well. It needs to be a full, what they call rent and insure, which means that the people in the building, the new owners of the business, should be responsible for everything on the inner shell. So that will be things like, the lighting and the flooring and the doors and painting, redecorating, any internal flooding, all that sort of stuff. And usually the landlord is responsible for keeping it air and watertight. And that would go in the agreement that the guttering and the roofing and any sewerage and that sort of stuff is your responsibility. But again, when you get that far, your solicitor should be able to guide you quite well. I'm more happy to take inbox messages on this if anybody needs some guidance on what they need to do. But I'm not a solicitor. I can only tell you what I'm legally using and what I'm legally aware of right this minute. Okay, so that's it. Either use the traditional method, get it valued, ask for a lump sum, hand over the keys, or you get the values, tie them into a 7 years minus 1 day lease, and then spread the costs alongside the rent so that it's easier for them. But get a deposit off them, 5,000, 10,000. I don't know how much the business is worth. It could be a £20,000 deposit, so that you've got some security that they are buying into this business, and maybe you've got some security as well for any damage that they do to your equipment.